growth is going to be moderate, that gives a lot of ammo for the Fed to kind of take their foot off the gas here. And in that case, the markets will go boom.
Chamath Palihapitiya is a Canadian and American venture capitalist and founder and CEO of Social Capital. He's a popular Bitcoin bull as well. Last year, he said that he thinks Bitcoin has replaced gold for good. He also revealed that he's put hundreds of millions of dollars into Bitcoin. His company has also been investing in some large crypto projects. Fair to say that he's really confident about where we're going from here. In this interview, we'll look at his stance on the financial markets, the current inflation rates, and how it's affected the current economic landscape. If you want to hear Chamath's recent predictions, then watch this video till the end, and don't forget to press the like button. Also, subscribe to our channel for daily updates. We post twice every single day. Now, let's look at his interview.
We still had some amount of rate uncertainty from the Fed. I think people weren't sure how aggressively they were going to hike. But by early this week, it was pretty clear there's going to be 2 50-point hikes, one in June and one in July, and then effectively a pause, because then the Fed funds rate will be at around 2%. And everything from there will probably be path and data dependent. Okay, that's effectively what they said. Now, I think the markets had actually already started to see that writing on the wall. So if you go back to, one of our favorite measures, which is the 10-year break even, it's effectively rolled over, which means that from the highs in sort of late April, it started to come down, which says that, they were thinking that, the inflation was not going to be as bad in the back half of the year. And then the second is that corporate credit, which is really what matters in some ways to the Fed, because that's where they can intervene. What is the spread above treasuries that a company can issue debt? When it goes crazy and it goes up, it means, oh no, the cost of capital is going up. That's going to be hard for companies to raise money. They may have to lay people off. They may need to get into cost-cutting mode, right? That's what goes through everybody's mind. But that's also now about 35 and 40 days rolled over, which means that the gap has started to shrink, between the US Treasury price and what, decent corporates can issue debt at. So it looks like we are set up for potentially a decent little rally here. The problem is it a rally that is sustainable, or is it a rally that's basically what we call a dead cat bounce or a bear market rally, where, you just get some 1 or 2 weeks of relief before the thing spears down again? And we're not going to know, although tomorrow on Friday, there's going to be a really important set of inflation data that gets released, and I think everybody's going to be sweating these details. So right now we're in a moment of pause, and there is the potential, if this data comes back as reasonably good, which means prices are, not escalating as much as we thought, inflation is not going to be as bad, growth is going to be moderate, that gives a lot of ammo for the Fed to kind of take their foot off the gas here. And in that case, the markets will go boom. I think we're in a pretty reasonable place here. The real question is now, what do you need to take the market lower? And this is more of a nuance, but when you look at companies that are now quote unquote cheap, right? Let's take an example like we hear a lot about Google or Facebook, right? And people will say, my gosh, this is cheap, because if you run a screen on it, it's like 10, 11, 12 times price to earnings. Well, the price because you can look on the screen. The real question is, are the earnings right? And the thing that can take the market lower is if you actually think earnings are modeled incorrectly, right? So we saw it this week as well, Snap, completely just blew themselves
46% down intraday yesterday, I think.
I just want to say something about Snap.
In one day.
They have the most incredible propensity to self-immolate on earnings calls than any other company I've ever seen. There's probably been 3 times, no less than 3 times over the last 4 years, where I don't know whether it's just poorly scripted or not well rehearsed, or the people that are helping Evan get ready for these things, but these are disastrous calls. Facebook's had a couple in its lifetime, but Snap consistently, probably once every 18 months, will do this. Anyways, the thing just completely implodes. The stock implodes by 48% or something. And then it, rolls over to companies like Facebook and Google, who then are off 8 or 10%. My point in telling you this story is that if you think Facebook and Google, just as an example again, are cheap at 10 times, well, you better hope that the earnings are right. Because if the earnings are actually wrong, that's actually 27 times and 19 times. I'm making these numbers up to give you the example because the earnings are fundamentally wrong. So that's the risk now that's left in the market, in my opinion, that could take it much, much lower, is if that, all of this slowdown really contracts spend and the earnings are actually not accurate. The forecasted earnings will need to be revised over the next 2 or 3 quarters, and that's where we will probably see the low. If, however, growth is muted and the Fed can, as Brad said, it's a really good analogy, now just course correct by degrees, a degree here, a degree there, we've probably consolidated the lows.
So, even as great as Snap's results actually look, they were up 38% year over year. They're generating over 100 million in free cash flow.
The guide was terrible because what they said was our our earnings are not modeled accurately.
Right.
And so that's the risk that you now have to take to every company. You cannot look at a screen on Yahoo Finance or Bloomberg, look at a price to earnings ratio and say, wow, 7 times, that's so cheap. It may not be 7. You have to do your own work. It could actually be much higher than that because the earnings may be at risk. I think the other thing is that there's a lot of companies that are going to have to get religion on free cash flow conversion ASAP. And I just think that most CEOs, to be very blunt, are poorly educated and innumerate. So their level of numeracy to even understand this is pretty poor. And most board directors are equally. It allows you, again, everybody starts to throw out this whole thing, which is, oh my God, you can never slow growth and the company will die. And yeah, maybe in a vacuum that's true. But when every other company is fighting tooth and nail to survive, the only thing that you need to do is actually survive. By surviving, you win.
Yes.
And if you can basically make your cash last as long as possible, even if you cut to the bone and stop growing, if you come out the other end and you're the only company that's left, you will win and run over the market. You may have pushed to the right a few years your plans of world dominance, but they're still available to you. It's the company that foolishly thinks that they can continue to spend money at the same rate or in the same ways that are going to learn this hard lesson. Because I think that investors are not going to tolerate being able to, provide incremental capital to organizations, funds, who are then, misallocating that capital to basically support a poorly marked portfolio. And I think that is going to be the real come to Jesus that actually makes all of this thing come clean. Like pension funds, family offices, endowments, all these organizations are smart enough to realize that they're giving good money after bad if what those folks are going to do is not demand portfolio rehabilitation and instead are just going to basically keep the marks of their old funds because they're just in a game of waiting it out. I think that most growth-oriented funds are looking at their portfolios and they're trying to balance 2 strategies. Strategy 1 is get into massive rehabilitation mode. The problem is most of these people have never built or run a company, so they have no idea how to rehabilitate anything. They're, market momentum folks, and in that they were excellent. But in actually helping CEOs build and rebuild a business, I think that they're not as well suited. Doesn't mean they can't do it, but they're not as well suited. That's path A. But I think that path is very painful, and it requires you to take medicine, the bitter medicine, which is to basically mark your portfolio down 50 or 60%, just like the public market terminal valuations have gone down. The other alternative is to basically raise enough money to do, for example, unpriced converts into those same companies so that you don't have to remark, so that the auditors will be allowed to carry these fake valuations. You can maybe mark it down 10 or 15%, but you don't have to mark it down 50 or 60%, and hope the market returns to its previous state. But as we've all talked about, that previous state is probably unreliable because it was a moment where we had a global pandemic where we took rates to 0 and we printed $9 or $10 trillion of excess liquidity that inflated these things. So I got to think that, prices in 2019 were a little bit ticking up. 2020 were really ticking up. 2021 was egregious, and 2022 is where it all comes home to roost. I think there's still going to continue to be examples of folks who basically run themselves into a brick wall because they don't want to make the hard decisions. That is going to be more exaggerated in Silicon Valley because we have a culture of tolerance and we have an economic business model that supports kind of irresponsible decision making and supports poor governance. Look, I've said this many times, but a fund's job ultimately is to make a very important decision about whether they truly care about generating massive returns or whether the fee income becomes so meaningful so as to drown out every other incentive that they have. And I think by and large in Silicon Valley, if you track all of the increased frequency in fundraising, you can also probably follow those dollars, and they generally will be the most poorly run. They'll be held the least accountable. And I think those will have the largest negative outcomes. And then instead, if you follow the dollars of the real practitioners who have discipline, they look kind of sheepish and silly for years in the middle of a rally, but they're the ones that are able to really reset and help some of these few companies really win. And I think that you're going to go through that cycle over the next 4 or 5 years. The idea that over the last 4 or 5 years you optimized for anything except the market beta was kind of dumb. And the worst thing that you could have done in that period was confuse alpha and beta, meaning alpha is what you are able to do because of your discrete skill versus anybody else. Beta is when just the market goes up. Said differently, you could take any NBA player and put them on a high school basketball team, and they would be the college player of the year. Any single one. Okay? That's beta.
Yeah.
If you then can be the MVP of the NBA, that's alpha.
Yeah.
Okay? And I think that a lot of folks were made to feel very silly or a downer or a wet blanket in these last few years who will probably have the last laugh.